We all think we know what money is. It's the cash in our pocket, the number in our bank account. Pretty simple, right? But what if I told you that behind this everyday idea, there's a huge distinction hiding in plain sight that will completely change how you look at every transaction you make?
So let's just dive right in with a provocative question. Is that number you see in your banking app, is that really the same thing as a euro coin you can hold in your hand? You'd probably say, of course. But the real answer is way more interesting.
And the reason it's so complicated is that most of us are missing a huge piece of the puzzle when we think about money. To really get it, we need to uncover this fundamental distinction. See, the key to unlocking all of this is actually pretty simple. It's the fact that there isn't just one kind of money. Nope, there are two. And getting the difference between them, well, that changes everything. All right, so the first and maybe the easiest way to tell these two types of money apart is to just ask one simple question. Who makes it? And right away, that one question splits the entire world of money into public and private. Okay, so on one side, you've got public money. This is the official stuff, right? The money that's backed by the state and issued by a public authority, like the European Central Bank or the Fed in the US. And this is what we usually think of as cash, the actual banknotes and coins. But interestingly, it also includes something most of us never see: central bank reserves. That's the money that commercial banks use to settle up with each other at the central bank.
So what's on the other side of the coin? Well, that would be private money. And as the name suggests, this isn't created by the government, it's created by private companies, specifically commercial banks and other financial institutions. So what exactly is this private money? Well, you might be surprised to learn that it's actually the money we use almost all the time. That balance you see when you log into your banking app, your bank deposits. That's all private money. It's not a pile of cash sitting in a vault with your name on it. It's basically just a digital entry, a number in your bank's computer system. So, let's just quickly recap this first big idea. Public money, that comes from the central bank. Private money, that's created by commercial banks. Simple enough, right? But believe it or not, asking who makes it is only half the story. Now we get to the second and, honestly, probably the more important difference. It's not about where the money comes from, but about what it can legally do. This really gets to the heart of what gives money its power: its ability to completely wipe out a debt.
And there's a technical term for this. It's called discharging power. It's just a fancy way of saying it's the ability of money to extinguish a financial obligation. When you pay for something, this is the power you're tapping into.
And this is where that term you've probably heard before, legal tender, becomes super important. Public money, it has full discharging power because the law says so. It is legal tender by its very definition.
So what does that actually mean in the real world? It means that if you owe me, say, 100 euros, and you offer to pay me in cash, which is public money, I can't legally say no. The moment you hand over those banknotes, the debt is just gone. Poof, extinguished. End of story.
Okay, but wait a second. This leads to a really interesting question, right? If the money in your bank account, that private money, isn't legal tender, then how in the world does a bank transfer or paying with your debit card actually settle a debt?
Well, the answer is that it's all based on agreement. It's a two-step dance. First, you, the debtor, you offer to pay using your private money from your bank. And then, and this is the key, the person you're paying has to agree to accept it. It's not a legal requirement, it's a contractual handshake. And this is a really crucial point. Private money only gets the job done. It only discharges that obligation if and only if the person on the receiving end agrees to take it. So why does everyone agree? Simple. Because we all trust, we rely on the promise that you can convert that private money into public money, into cash whenever you want. That promise is what holds the whole system together. Okay, so let's put this all together in one place. If we're looking at who the issuer is, it's simple. Public money comes from a central bank, private money from commercial banks. But if we look at its power to settle debt, the difference is huge. Public money is legal tender. Its power comes from the law. Private money's power is contractual. It only works because people agree to accept it. Right about now, you might be thinking, okay, that's kind of interesting, but why does this actually matter in my day-to-day life? Well, it matters a lot, because this entire public-private framework is absolutely essential to understanding where money is headed next. And spoiler alert, it's all digital. So from now on, every time you see a headline or hear those buzzwords, CBDCs, the digital euro, stablecoins, you'll have the mental toolkit to know exactly what they're talking about.
This public versus private distinction is the secret decoder ring for all of it.
Because in this new digital world, the same fundamental rules still apply. A central bank digital currency, a CBDC, that's just a new digital form of public money. And all those other innovations like deposit tokens or regulated stablecoins, those are just new flavors of private digital money. It's the same old concepts, just dressed up in new technology.
So, let's leave you with one final big question to think about. As physical cash starts to fade away and we move towards a future that's almost entirely digital, this line between public and private money becomes more critical than ever. The question isn't just what's in your wallet anymore. The real question is, who will you trust to create and control your money?